Options trading. I like to have options. I'm sure you like to have options, and in this video tutorial I want to talk about options. I'm talking about options trading in your account, and I want to kind of unpack what that means for you and give you a little bit of an insight into what will happen if you give me permission, which is what I'm asking for, to trade options in your account. So I've posted at bayrockfinancial.com options trading, and basically I took this information directly from my favorite source of information for investing and trading. It's Investopedia. So when you go to this post at Bayrock Financial, it will have links back to where I got this content. So hopefully that attribution will be sufficient, but if not, I'll delete it. Some great writers at Investopedia, and that's again where I got this. So I put this information here just to give you a quick place in the same page that I'm posting this video to just read all about options if that's something you want to do. But the purpose of this video is to show you an options trade. So I'm going to do that. I'm just going to jump over to my iPad now, and we're looking at a chart. It's a very static picture. I think I can make it move around. Maybe no. I can do some things sometimes on my iPad that surprise me, but this is just an image. It's a chart of SPY, and I've said many times before, if you've listened to me talk about investing, if I could only trade one security, if there was only one investment I could make in my lifetime, it would be the SPY. It's an ETF, an exchange traded fund. It's kind of like a mutual fund, except way better. An ETF trades like a stock. An ETF, an exchange traded fund, is a very efficient investment vehicle for tax purposes, but mainly it's beautiful because it allows you to trade it like a stock. So for example, if in the morning the market is down 1,000 points, the market or the S&P 500 could be down 100 points. That would be a lot. The SPY would be way down, and so I could purchase this ETF in the morning while the market was way down, and then at the end of the day, if the market was way up, which we've seen multiple times in this year of 2022, where the market is very low in the beginning of the day, very high at the end of the day, or vice versa. So this one investment, the SPY, it's just an example. I want you to understand that this one investment gives me the ability to trade it like a stock, but it also has the option of trading options. So that's what I want to show you in this short video. So the SPY, as you see, this is a six-month chart, and it's down a lot for the year. Worst opening 6 months of a year since World War II, I believe, or maybe since the Great Depression. It's been a horrific year in the stock market. We've had tremendous volatility, meaning the market goes up and down, and that's why options make sense now in your account, and that's why I'm creating this tutorial. You should be receiving, or you will be receiving, an email from me with a DocuSign envelope asking you to give me authority to add options in your account so that I can trade options in your account. So for example, let's say in your account you own this ticker SPY, and you probably do. I buy and sell this in your account on a regular basis, especially in a tax qualified account. So your IRA is ideally what we're talking about in this video. So I'm buying the SPY. You already own it. So let's look at what happens when we jump into an options trade. So here we go. I'm now in this is the tool that I use just to follow what the market is doing. And what I've done is I've opened the SPY, and I know this may not even interest you in the least, but I want to help you understand what it looks like and what it means for me to trade an option in your account. So here we have, you'll see that right here I can pick a date in the future. Let's just say that I want to pick July, the middle of July, July 18th. So then in this chart that I'm opening up, On the left side are calls, on the right side are puts. Those are the two kinds of options that I want to trade in your account. So just remember that if you already own 100 shares of SPY, then I could sell one contract of a call. Now, in your IRA, the rules are you can't just sell short stocks. If we're talking about a different type of account, we could, if I believed that SPY was going to go down in a regular account with margin, I could sell it short, and we could make money when SPY goes down. But we can't do that in an IRA. But what we can do in its place, since you already own 100 shares of SPY, I could sell a call. So if I sell a call for July 18th, 2022, and if I pick a number, so today the SPY closed at $380. So let's say that I think it's going to keep going down. And so I reach out for 2 weeks and I look to see what kind of premium, what kind of credit, what kind of money could we make and produce income in your account if we sell a call on the SPY. So we're looking at, on the left side again, the calls. If I sell to open a call right at the money of $380, let's say that we're pretty sure it's going to go down and we just want to keep the profit. Let's say that we bought SPY at $360 and we've got $20 profit, and I want to keep that profit for you, and I'm afraid based on that chart that it may keep going down. Now, it may go up, it may go down. I don't know unless my crystal ball is fixed, and it's not fixed. It's still in the shop. So I don't know if it's going to go up or down. But if I wanted to protect the gains that we have in SPY and even make a little money, I could sell a contract, sell a call for 18th of July, not that far out. And how much would I be able to make? So this, if you look at this number right here, you can't see my thumb, but if you look at that number right next to the 380, you see 881 or 884. These are the bid ask. So the bid is 878, the ask is 884. So if I sold a contract on this, I would get paid, you would get paid, you would receive a premium, a credit, basically income of, let's say we got the ask price. So I would set the price, I'd do a limit so that we get the best price possible, and we'd get $8.84 per share. That's $884 credit on your 100 shares of SPY. What happens then? If the stock goes down, if SPY goes down between now and the 18th of July, you get to keep that credit. That $884 is yours. It's income. It's a credit. You just keep it. What happens if the stock goes up? Well, let's say that the SPY goes up to $385 a share. You're probably going to get those 100 shares called. That means you're going to give them up, and basically they're worth $385 at that point. If at that day when this expires, they're trading at $385. But remember, you got paid $884. So you're basically making $300 for that, $380 on that trade. You're losing your stock, so the stock goes away, and in its place you get paid $380 for the stock. You get $380, but remember, you got $864. I think that's the number, $884. That's what you got paid for a credit. So you gained, you made money. And if the stock trades for $379 or anything below $380 between, at the expiration on the 18th of July, then you get to keep that $884, and then we just turn around and do it again and create another credit. Now, that's a call. That's what we do to protect against your holding, your stock going down. So in this case, it's the SPY, my favorite stock of all. And so that's a call option. and that's what I would do, is sell a call to protect your gains and create some income in your account. Now let's say we have 15 different holdings. Each of them would typically be an ETF, because I love ETFs. I love highly liquid, highly traded ETFs like the SPY. It trades millions and millions of shares every day, and it's always got a penny spread, which means it's super easy to trade. It's very, very liquid. It pays a dividend, and it's way better than any mutual fund on the planet, if you ask me. That's why it's in your portfolio. But trading options is one of the reasons that we like ETFs as professional money managers. And so this example of selling a call helps you understand how I could create and generate some income in your account. Now, let me just say, I probably wouldn't sell a call today. If you look at that chart, it's a downtrending chart, and that's ugly and that's bad, and we don't like that. At some point, and probably in the pretty near future, we're going to see the market take a really nasty dive. And at that point, we want to go buy as much as we have cash to buy. So right now the S&P 500 is around 3,800, 3,850 or whatever. And so if it gets around 3,600, I'm going to be a buyer. I would not be selling calls when the market pulls back that much. If the S&P 500 drops to 3,300, I would be buying more. And if it dropped, I kind of wish this would happen. If it dropped to 3,000, we would all see huge losses in our accounts. But on that day, we would be wanting to buy as much as we have cash to buy, because at that point, at that level, when it drops that much, when the market becomes that oversold, it is the best opportunity. And that's why you pay me to be paying attention to your account and making those kind of decisions. But when the S&P 500 goes up and it starts to get to that point where there are certain resistance levels that are indicators, I watch those very close. And on those days when we have the market's gone up for a few days, those are the days that I would want to be selling calls to protect your investment and basically short that holding. That's a way of shorting, or putting a hedge against that investment. And so we do that in a very specific way with calls. Now, again, I told you that the market's been going up and down, and you can see that. So let me talk about a put for a minute. That's the other side of a call. So a call is something we would sell to protect. It's a covered call, not a naked call. It's a covered call, which means you own the stock. And if you own 100 shares, we can sell one contract. In this case, we said that would be about $884. And you would get that credit, get that income, get that premium, as long as that SPY closes at 380 or less. You would keep that, and then we would just do it again. If it's trading at higher than that, you might get it called away, and then I would wait for a day when the market pulls back, and I would just go buy another 100 shares and wait, and then put another or sell another call. So that's the call side, but there's also the put side. The way the put works is kind of the opposite. So you're seeing again the S&P 500 ETF, SPY. And in that chart, you see that it's gone up and it's gone down. And on the days that it's gone way down, I'm paying attention to the market. And those are the days that we get the best possible premium, the biggest, fattest, because of volatility, we get the biggest, fattest payday for those kind of options. So today the market's down a little bit. So let's say that we think that the S&P 500 is going to go up from here. Instead of 380 where it closed, let's say we think it's going to get back to, the S&P 500 is going to get back to the 4,000 level. Now remember, the S&P 500 was at 5,000 not that long ago. And today it's at about 3,800. So getting to 4,000 is very likely possible. You know, it may not happen tomorrow, it may not happen in 3 days, but in a month, it's very reasonable. Once we start having more news about this inflation mess dissipating, it's very likely that the S&P 500 is going to go up. So we might prefer today to sell a put. If you had $1 million in cash in your account, today I would be selling a put, because we want to put your money to work. So the way that works, this, looking at the same chart, the S&P 500 is about 3,800. The SPY, the ETF that we use to trade the S&P 500, it's sitting at 380. So what we would do today, if you had cash and we wanted to get that to work and at least put some of your money to work, instead of buying 100 shares of the SPY, what we would want to do is sell a naked put. So let's look at that. So if we said, instead of buying the S&P 500, the SPY, for $380 a share, let's sell a naked put. And if we did that, we would get, now we're looking at the right side, we're looking again at an 18th of July, so only a couple weeks out, we would get paid a credit, a premium of $850 if we sold it at the ask price. And that's today. That's if we sold it today, you would get an $850 bonus or credit for buying that stock. And if SPY drops to $379 in a couple weeks, you're going to get put that stock, which means you're going to own 100 shares of the S&P 500, the SPY, SPY. You're going to own that, and you're going to pay $380 for it, even though it's trading at $379 or $365, whatever it's trading at. You have to buy it for $380 because you got paid $850 as a credit because you sold a put. Or I did that for you. And when we sell that put, that obligates us then to buy that stock when someone on the other side of that trade puts it to us for $380 between now and the what do you call it? The option strike day. That's not what it's called, but I can't remember so the expiration is the 18th of July. And if the SPY is trading for under $380, if we sold a put for $380, we're going to own that bad boy at $380. But think about that. Just think about, this is a very important point in this whole process. If I'm going to be buying the S&P 500 right now for you today because it's down to $380, if I'm going to buy it, why not get paid a credit so that I get the almost $900, $850, and I get that credit in your account, and maybe we still buy the stock because it may drop to $379, it gets put to us for $380, but then we have the additional almost $900 of a credit. It's kind of like a bonus. So with volatility the way it is, and this is important, I don't want to get too deep inside baseball, but when we have volatility in the market, what happens to the pricing in options is they get swollen, they get big. And when we sell options, that swollen volatility that makes the value of those credits much higher, what happens is there's an element called time decay. I learned how to trade options on the Chicago Board of Options Exchange. A very smart guy taught me how to trade options, and he had 2 words that he drilled into all of his students about how to make money, how to create high probability of success trades using options. His 2 words were very simple: sell junk. His words, not mine. But the point was, he wanted us to understand that the probabilities go in our favor significantly if we're selling premium instead of buying options. So I am a seller of options, whether I'm selling a call to protect your investment from going down. I would sell a call on a day when the market's high, and on a day when the market's low, instead of just buying that stock, I would be selling a contract, a put, a naked put. And so that's the way I would use those 2 option strategies to manage risk in your account and really to create an additional income stream in your account. Now, there is no there is additional risk using options, but hopefully what I've explained in this video helps you understand the distinction between a call option and a put option and how it would work in relation to this one ETF, my favorite investment of all, the SPY. It works really well. It works not just with the SPY, but again, if we have a dozen different holdings in your account, if we own at least 100 of them, we can sell a call. In your IRA, we can't sell naked calls. We could do that in your margin account. It's much more risky. In fact, the most risky investment strategy there is ever is a naked call. Think about it. If I sold a call on Amazon when it was at $100 a share and it went to $3,000 a share and I sold a naked call, that means we have an unlimited amount of risk if we sell a naked call. So I don't like naked calls. I would very rarely sell a naked call. I've done it and I will do it again, but it's a very risky trade and it's only something you would do in a very specific situation. So in your account, I'm asking permission. I want to educate you and make sure you understand the risk for me to sell covered calls and to sell naked puts. And the only time I would ever sell a naked put is on a certain kind of investment like the SPY or another ETF that's highly liquid with a razor thin bid-ask spread, like 1 penny. That's what I'm looking for. And an ETF that pays a dividend and it's super easy to trade and it has huge volume. Those are the kind of ETFs I put into your portfolio because not only do those ETFs trade like a stock and they're highly liquid, there's huge volume, so there's never a problem trying to sell or buy. And that's what makes up your portfolio, and the reason we use those holdings is because I want to be able to use options as a way to manage risk in your account. So I hope this helps. Send me a message, email, call. Let's talk if you want more information or if this hasn't been enough. I tried not to go too deep. I know most of you don't really care about the way that it all works, but I feel like I owe it to you. I want to be clear in terms of making sure that I've done my job educating you before you sign that DocuSign envelope giving me permission to put options to work in your account. I'm working really hard to do that this season. It is today's June 29th, 2022. So thanks for watching my video and I'll talk to you soon.